What's up, YouTube? I'm back again with part 2 of the 2020 full year results. I will be doing an overview video later on. Stay tuned for that. This is going to be the question and answer portion of the video where some of Rolls-Royce's biggest investors will be grilling the CEO and CFO, trying to ask them the tough questions. If you like the video, please remember to hit like and subscribe. I appreciate all the feedback. You guys have been awesome. And yeah, without more to say, let's get right into it.
Thank you. As a reminder, ladies and gentlemen, if you do have a question or comment, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your question, please press the pound or the hash key. Once again, it's star 1 for any questions or comment. We have our first questions coming from the line of Andrew Humphrey from Morgan Stanley. Please ask your question.
Hi, thanks very much. I've got a couple, if I may. One is on flying hours. I mean, I think over January and February, Rolls-Royce flying hours, as far as we can tell, were around 36% of 2019 levels. Assuming they stay at a similar level over the rest of the first half, are we effectively saying, we need to be at 75% of 2019 levels in the second half to meet the cash guidance for this year? And my second question is a sort of bit longer term around XWB. You've obviously secured the exclusive position on the 900 until 2030. I was curious about the reason for specifying that variant. I mean, I assume that the 800 and the 1000 would not be sufficiently large volume opportunities in themselves for a competitor to make significant inroads in there. I'd be interested in your view on that. And also, does the kind of specification of sort of 2030 as an end date for that exclusivity mean effectively, that could be dual source from 1st of January 2031? Thank you.
Right. Thanks very much, Andrew. Well, let me take both of those. I mean, the engine flying hours, undoubtedly, we can see what's happened in the first couple of months, and there is a huge amount of uncertainty still in the timing of the recovery. And yes, our base case does expect recovery to resume in the summer. Things like vaccine rollouts and the efficacy of vaccines are important to that, but also airport testing or health passports or whatever the solution is going to be will also require government-to-government interactions and lastly, public confidence. People have to actually get on the aeroplanes. So yes, there's a lot of uncertainty, and yes, the arithmetic that you suggest about overall percentage of engine flying hours is there. Of course, don't forget engine flying hours. There isn't a literal connection of engine flying hours to our cash performance this year, but there's definitely a directional relationship, and our base case does depend on that recovery. So we'll just have to wait and see, and we're going to concentrate and continue to concentrate on the things that we can control and manage the things that we can't control, like timing and pace of recovery. On XWB 900, you'll recall 12 months or so ago, there was a huge amount of speculation about our competitive position on A350 and GE having conversations with Airbus and so on. A huge amount of speculation and uncertainty in the community, and so we're delighted to put that speculation to bed for the remainder of this decade. And you're right, the 900 variant is the volume variant. It's a hugely successful aeroplane. And technically, yes, when a period of exclusivity finishes at the end of 2030, then, it could be dual source at the end of 2031. But as I pointed out in the presentation a moment ago, the 2030 date does coincide pretty much with the timing of likely ultrafan and next generation aircrafts and those sorts of things. it's a useful round date as well, to say exclusivity to the middle of March 2031 or something like that doesn't seem like a very it seems spuriously accurate date. So we'll see. But for now, we're delighted with confirming the exclusive position across all the variants of the A350.
Great, thank you.
We have the next questions coming from the line of Celine Fornaro from UBS. Please ask your question.
Yes, good morning, gentlemen. Good morning, Isabel. If I may, I would have two questions, please. The first one is regarding your 750 million free cash guidance for 2022. So if we try and work it backwards a little bit in terms of the businesses, we know that roughly the non-aerospace part of the business would generate approximately 700 million of cash, and then you would have 600 million of headwinds coming from the tax, interest, and the hedge book. So that would imply that aerospace basically needs to generate roughly 600 million in 2022 with a scenario of 80% flying hours. I just, this is way above the 2019 level, which was in the high 400s. Maybe you could just explain to us the path towards that, and if this logic seems accurate based on the headwinds on aftermarket and the rebased volume offset somewhat by restructuring. And then my second question would be, I've just seen this morning a new appointment with immediate effect on the board by Mr. Paul Adams. So maybe you could share a few words on his background and what he would bring to the business, given his operational focus as you are midway through a restructuring and a potential portfolio sale of some assets. Thank you.
Okay. Hi, Celine. It's Stephen here. So let me start with the bridge to the £750 million free cash flow as early as 2022 that you referenced. And you're absolutely right. The key driver here will be the recovery and turnaround in civil aerospace. And if I just take you through, if I just work, let's say, from the outflow of £4.2 billion that we saw in 2020 and take you through to 2022, and what are the key drivers of that material improvement in free cash flow over those 2 years. So first of all, the single biggest driver is, of course, the improvement in the engine flying hours that we see. Close to £1.2 billion of cash flow improvement, and that's essentially driven by engine flying hours rising from the 43% of 2019 levels that we saw in 2020, particularly in the final 9 months of 2020, improving to the guidance that we're giving today of our expectation of around 80% of 2019 levels in 2021. In 22. And every 1%, as a rough rule of thumb, equals £30 million. So there's your first key item, really, in that bridge. We're then also expecting to see about £900 million of improvement in civil aerospace just in market impacts. And this will be around the regional engines, the V2500, and just generally wide-body time and material improvement. That's going to be a big driver of that. We're also going to see higher spare engine volumes in 2022 than we saw in 2020, which was a pretty subdued year for spare engine demand, as you might expect. And finally, a key thing that we shouldn't forget about in civil aerospace is we're going to see around £300 million lower Trent 1000 costs that were about £520 million this year, that will reduce to around £200 million or so in 2022. So that's another key driver. When we look at power systems and ITP, you put those two businesses together, we're probably going to see around £200 million of improved cash flow out of those two businesses in 2022. Another key item that we're working through, and in fact this is an item that we've made good progress on during 2020, is our group restructuring program. We're expecting a £500 million contribution from that compared to our 2020 numbers. Those are reductions in operating costs and capital expenditure. Just as a reminder on that, the cash mitigations of the £1 billion of savings that we've delivered in 2020 were against our pre-COVID budget, whereas the £1.3 billion of restructuring savings that we first indicated on the 20th of May when we announced our 9,000 headcount reduction, they're measured against our 2019 cost base. So in short, this difference means that despite the 2020 mitigations, there's still £500 million of benefit to come across 21 and 22, and not just the headline £300 million. Another key point here is to bear in mind that we actually see a reduction in the 2020 temporary headwinds as well that we saw. And these are two key areas, really. Number one is in the fixed cost under recoveries, particularly in civil aerospace, to the sharp drop in volumes that we saw in 2020 as COVID really kicked in, and that we've talked about the OE volumes just now. And then we've also got a one-off FX impact in 2020 as well, as our US dollar costs exceeded our revenues. And in that scenario, then, we translate rather the achieve rate at the prevailing spot rates at the time, closer to sort of 130 or so rather than the 150 or so in the hedge book. And given that our costs exceeded our revenues in 2020, that has a material around £400 million FX headwind to 2020 that won't be repeated in 2022 as our revenues and costs get closer aligned in US dollars. Finally, we had a £200 million increase in pension interest and tax pension cost swings in 2020 due to a deferral of the 2020 cash costs into 21. So that's another item in that respect as well. So that gets you to the £750 million as early as 2022. And I would, put some qualification around that, very much dependent on the 80% of engine flying hours that we've highlighted today, and also very much dependent on the pace of our restructuring program and the delivery of the savings as well. I think we've made very good progress during 2020. There's still much to do, particularly as we get into the discussions around the potential site implications in civil aerospace. But we're pleased with the progress that we're making and feeling confident about delivering those full savings from our restructuring program. That's it really on the 750. Warren?
Great. Thanks, Stephen. And on Paul Adams, well, we're very pleased to welcome Paul Adams to the board. I point out that we also highlight that 3 of our directors are leaving the board. They're timing out. And so, this is part of the normal succession process. Now, Paul was head of engineering at Pratt & Whitney for some years, and so he clearly has very relevant industrial experience. That compensates for some of the industrial experience that we are losing with the timing out of those 3 directors. But it's also very relevant industry experience, and I think his technical background is going to be particularly useful as we go through the next decade with next generation engines to bring on and transition to new technologies.
We have the next questions coming from the line of Chloe Lemarie from Exane BNP Paribas. Please ask your question.
Yes, good morning, everyone. Thanks for taking my question. I have 2 as well. The first one would actually be building on Seven's question on 2022 free cash flow. If we keep all things equal and add back the missing 20% flight hours to go back to 2019 levels, I would assume you could deliver about £1 billion from civil and even possibly 1.5 once the hedge book and Trent 1000 headwinds are gone. So could you say whether this is broadly your ambition for the division, or would there be elements that would cap that performance going forward? And the second is on your R&D and technology roadmap. Would you see the need to return to past R&D peaks by, let's say, the middle of the decade to help fund that innovation to move toward the decarbonization goals, or are these technologies actually less R&D intensive than prior programs, having quite a lot of commonality with your existing portfolio? Thank you.
So, thank you. I'll do the first question, Warren, and I guess you'll do the second.
Yep, that's fine.
So, it's a good prompt, actually. The £750 million as early as 2022, that actually includes Trent 1000 costs. We're guiding those costs in that year between £100 million to £200 million in Trent 1000 costs, and that's pretty much the final year of material Trent 1000 cash costs. And then we've also got within that number the cash cost of closing out those FX forward contracts in respect of 2022 as well, and that's around £300 million. So, you put those two numbers together, neither of which will be permanent. The Trent 1000 costs will stop earlier than the FX cash costs, and you'll see in the appendix the timing for those total cash costs. And just as a reminder, on a profit basis, we took all of the profit impact, that £1.7 billion, in underlying costs as part of our financing costs in 2020. So the P&L impact of that has already rippled through, but the cash profile ripples through across from 2020 through to 2027. So your interpretation is correct that one could see a route to free cash flows greater than £1 billion in the absence of those two headwinds. Warren?
Yeah, and the question on R&D, well, I mean, clearly we are talking about having an organisation that is a science-led innovation, and so we could spend almost anything on R&D, but our challenge is to make sure that we can do this in a profitable and effective way. And we've made, if you push COVID to one side for a moment, we've made lots of investments over recent years to enhance the productivity and efficiency of our engineering efforts. And so, yes, we remain absolutely confident that we can maintain R&D within the sort of envelope that we've now established, which is significantly less than it has been over the last several years. But don't forget two factors driving that: the improvement in efficiency and productivity, but also the fact that we're coming to the end of the big investment cycle in new engines in our civil aerospace business. And that's why we're able to make a massive change, like I showed on the slide a moment ago, in terms of how much we're spending on civil aerospace, tilting the investments that we are making into the other divisions and also into the newer technologies. So you'll see the absolute level of R&D remain roughly flat, but you'll see the shape change significantly.
Thank you very much.
We have the next questions coming from the line of Chris Hallam from Goldman Sachs. Please ask your question.
Yeah, morning everybody. So 3 quick questions. First, on slide 14, are you able to put any time frame around the 2 billion of cumulative organic free cash flow that you've highlighted after 2022? And should we assume that that's net of a 2.5 times dividend cover ratio, i.e. that you're paying out 40% of free cash flow in dividends over that period? Second, back in February 2019, you withdrew from the NMA due to the tight schedules associated with the programme. If it comes, it seems like the EIS date for that programme has been pushed out to 2027 or so. And obviously, you've continued to make progress on UltraFan in the past 2 years. So is there a chance that you're interested in that programme once again? And then finally, if the UK were to significantly reduce the number of F-35s it plans to operate, would that have a meaningful impact on your defence business, or should we think about that being driven more by the global fleet number than by the UK fleet number?
This one. So we're really talking in the midterm, sort of 3-4 years is the time frame that we're referencing there. I mean, clearly, a lot of uncertainty ahead still, a lot of restructuring to do, and a lot of engine flying hour recovery to happen. But that's a sort of rough guide on the timing. And sorry, Chris, I missed the second part of the question there. I was writing down the first part of the question. So what was the second part of the question again? I missed that one too.
Yeah, sorry. So pre-crisis, you used to operate on a 2.5 times dividend cover ratio, right? So you used to pay out 40% of your free cash flow in dividends. So as you try and get to net cash, are you assuming within that net cash position that you will have paid out around 40% of free cash flow in dividends?
No, that is not part of the of that modelling right now. I mean, it is something that we clearly will be considering, as we get into sort of 2023, I would imagine will be the earliest that we'll start considering the dividend coming back. I mean, we clearly want to be in a world whereby we've come out of COVID the other side. We're confident in our cash flow profile. We are very keen to get back to that net cash position that you just described, and we can see a route there, as I said, over the next sort of 3-4 years or so, and at that point, I think we'll be ready to have the debate about dividends. But right now, we're laser focused on our disposals program, generating the at least £2 billion from that program. I'm very focused on the restructuring program and getting this business back to the sort of economics that makes sense for Rolls-Royce. That £750 million as early as 22, that's the first gating point, and then taking it beyond there, particularly as the Trent 1000 and FX headwinds disappear as well. But I think it's going to be around, at the earliest, the 23, 24 debate around the dividend pick up again.
Okay, and so your second question, Chris, was around Ultrafan and NMA, I suppose. And yes, you're right. We were very explicit about the reason why we withdrew from that proposed program a couple of years ago, and that was around the timing of our Ultrafan program. Our Ultrafan development has gone well since then, and we're sort of gearing up for a demonstration early next year. So then it will depend, whether we go ahead with it at that stage or whether we pause at that stage. It will depend on the timing of new aircraft programs, and the product is, or the product will be scalable. It will go across single aisle and dual aisle applications. It will be applicable for new aircraft, compatible with 100% SAF and so on. So yes, it's quite applicable. But we'll have to see if programs actually materialise and when they do. On the F-35s and the UK government's cancellations, then actually, obviously we're more geared to the whole sort of global F-35 program than just the UK program. But I would also note that the UK is talking about channeling that investment into the Tempest program, where we're obviously playing a crucial role. So that's it on the...
Very clear, thanks.
We have the next questions coming from the line of Andrew Gollan from Berenberg. Please ask your question.
Hi, morning everyone. So two questions for me, please. One on new engine volumes and one on shop visits. So on the new engine volumes, you've lowered the outlook slightly to, I think, 200 to 250, which is understandable, I suppose. So firstly, can you give us an update on the engine unit losses in 2020? And with that kind of lower for longer volume outlook, what's the trajectory you're expecting now for reducing that number going forward? And I guess I'm referring here to the pre-COVID target of a 0.4 billion per engine. And then second question on shop visits. Can you break out the volumes in 2020 as you have done before? So in terms of major refits and check and repair, and what is assumed within the cash guidance over the next couple of years in particular, please?
Righto. Let me start on the OE volumes. I mean, of course, on OE volumes, we are completely dependent on the airframer build rates, and I think in 2020 we demonstrated a certain amount of flexibility, being able to respond to that and manage our supply chain accordingly. So we will just respond to those build rates. As far as the losses are concerned, in 2020, whilst we can respond to the build rate changes, in 2020 the change was rapid. And so actually OE losses, as we came into the year at full throttle, we had no chance whatsoever of being able to respond and scale down our operation quite as fast as the volume disappeared. So lots of under recovery in 2020, and so in a way the 2020 number was pretty meaningless as far as our forward-looking ambitions are concerned. Now, for those forward-looking ambitions, however, that is precisely why we are resizing our business with this restructuring. That is to deal with the anticipated OE volumes and also the anticipated volumes of spare parts for the aftermarket. And so I think we'll be back with more news about OE loss ambitions, but hopefully we're resizing our operation accordingly to meet those lower volumes.
Okay, so shop visit volumes. We actually have quite a bit of this detail already on page 12 in the front half of the release, but I'll go through it in any event. In 2020, we had 272 large engine major shop visits, as you described them, those major refurbs. In 2021, that number is going to be closer to 240, so a slightly lower level. But that's going to start to it rises then quite sharply as we're talking around 2022 to around 400 in 2022. So that's the broad trajectory of major shop visits over the course of the next couple of years compared to our 2020 levels.
Okay, that's helpful. Thanks very much. And all the best, Stephen, in your next challenge.
Oh, thank you very much.
We have the next questions from the line of Ben Hillen from Bank of America. Please ask your question.
Yes, morning. Thanks for taking my question. One on retirement, because we haven't really touched on that in great detail. You do still have a relatively large exposure to four-engined aircraft, and retirements should be picking up as we go through 2021. So how do you think about the impact of retirements of 380s, 340s, 747s on that flight hour recovery? Thank you.
Yes, well, we're not guiding specifically on retirements today, but when we look at our engine flying hour forecasts, which are what the guidance is, or what's really the driver for our aftermarket revenue, then we're effectively taking into account that retirement risk. I mean, we know that airlines are preferring the newer aircraft. We showed that in the presentation. And we do have exposure to some of these older aircraft, and undoubtedly airlines are going to retire the less efficient aircraft more quickly and in preference to the others. So yeah, we're taking that into account. And in fact, in the data appendices to the presentation, then we've got the data about those older aircraft and what happened in 2020, and that's probably an indicator of what airlines are doing.
Okay, great. Thank you.
We have the next questions coming from the line of Robert Stallard from Vertical Research. Please ask your question.
Thanks so much. Good morning.
Morning.
I have a similar question to Ben, actually. Looking in the back in the appendices, roughly a quarter of your civil revenues in 2020 came from time and material and other, and that actually held in pretty well compared to long-term service agreements. So I was wondering if you could explain what was going on there, and also looking forward into 21 and beyond, how do you expect T&M to track from here?
Yeah. Well, no. Basically, we expect T&M to track with activity. The long-term service agreement actual numbers were hit by the catch-ups, and so if you want to look at sort of activity, then look at shop visits and how those are developing. And time and materials is more of a reflection of activity, whereas long-term service agreements are wrapped up in accounting as well as what's actually going on in the field. So that's the difference. And we would expect time and materials for those engines where we have time and material contracts, that will just reflect flying activity as we go forward, and therefore the recovery.
Can I just follow up on that? Because down 9% year on year would seem very good performance given the prevailing activity we saw in 2020. So I was wondering if there was any offsets in that number.
Yeah, well, I think 2020 we have to regard as an unusual year, and that's the way I'd sort of look at it. I mean, don't forget, we came into the year with a bit of a backlog of aeroplanes needing shop visits. We did take the opportunity of 2020 to burn down those queues, and that also meant burning down some of the time and materials demand as well.
Okay, that makes sense. Thank you very much.
The next questions come from the line of Jeremy Bragg from Redburn. Please ask your question.
Morning, guys.
Hi there.
I wanted to ask, please, again on the 750 guide for 2022. So you're achieving it despite lower engine flight hours. So I wondered if you could elaborate, please, on what the mitigating factors were and whether the cost cutting is just happening a bit sooner, or whether there's the potential for it to actually wind up being bigger than the 1.3. That was the first question, please. And then the second question was on the IAE royalties, which I wondered if you could quantify them for 2020 and give a kind of view of what's baked into the 2022 guidance, because that's, again, rather like the FX, something which doesn't last forever. Thank you.
Okay, so thank you for that. I'll start off with the 750. Yes, you're quite right. Back in October, with the rights issue, we highlighted a 750 million number as early as 2022, but based on engine flying hours being at 90% of 2019 levels. And we're now, reconfirming that 750 million, but obviously with a lower 80% of 2019 levels. I think the key driver of this is we actually made really good progress in 2020 in our restructuring program. We got further than we thought we would, and which means that we're delivering those savings earlier than we thought. And in 2022, the 1.3 billion pound of savings that we've quoted is the exit run rate at the end of 2022. So clearly we're getting that earlier. We're going to get it earlier in 2022 as well, and that's one of the key drivers. I think another aspect here is that there have been some benefits from COVID. We now have a 13-week rolling cash flow forecast by business that's given us more granularity than we've ever had, I think, into the operations of our individual businesses. We've been working hard on our budget for 21 and 22 since October with the rights issue, and that's identified, I think, some further opportunities for improvement, particularly around our capital allocation and operating costs to help us, reconfirm that 750 million pounds. We've got a pretty robust plan, I think, for the next couple of years now. There are some timing items that have impacted 2021, that £2 billion cash outflow in 2021 that may benefit 2022. So there's an item there just to bear in mind as well. I think, as it stands, though, we are pretty comfortable with the 750 million pounds as early as 22, but, very much dependent on that 80% of engine flying hour level in 2022 compared to 2019 levels. And again, that in itself is very much dependent on the recovery in the second half of the year, as Warren talked about, once the vaccination programs globally kick in. I mean, it's become apparent, talking to other countries and our customers in the aerospace sector generally, that the rollout of the vaccination program will be a really key gating item. And I think most countries are looking for a majority of their population to have been vaccinated before global travel restrictions start to get lifted in a meaningful way. So that is probably the one key indicator for us to watch out for. That's it.
I'll pick up the second half of the question. Just as I start on that, I'd also point out that the UK government is hosting the G7 this year, and this getting flying going again is a sort of multi-government thing that has to happen. And so our government relations team are very much spending time and effort lobbying the UK government to play a leading role in getting this risk-based approach to opening up flying again. Now, IAE royalties, simply pretty good reflection of the flying hours for that V2500 engine. And so in 2020, very roughly 50% down. We expect to be recovered quite a bit in 2022. Don't forget that this is effectively a single aisle. It's a short-haul aircraft. Short-haul recovers before long-haul. And so we would expect that to come back a bit more substantially than most of our activity, which is wide-body long-haul by 2022. But also don't forget that this royalty stream is going to disappear in 2027 anyway. So it's one to note, but it's not really the major driving factor of our business.
Thank you. A follow-on, please. What were the timing items that might benefit 2021? What were the timing items that might benefit 2022, please? You mentioned that, but I wasn't really...
The item here, and we talked about this before, is credit notes that we've issued in respect to the Trent 1000 customer disruption. I think in the main, that's one of the items that we, no surprise, our airlines using their credit notes earlier. And we're working actually pretty well with our airlines to help them through their cash pressures to the extent that it's, appropriate for us to do so and not damage ourselves. But I think it's the early use of credit notes is the one thing that I would point to that are in the 21 numbers and therefore benefit 2022.
Gotcha. Okay, thank you. And good luck, Stephen.
Yeah, thanks very much. Bye.
We have the next questions coming from the line of John Stewart from JP Morgan. Please ask your question.
Hi, good morning, and thank you for taking my questions. I have 4, please. Firstly, and similar to Ben's question, your base case is for engine flying hours to be 80% of 2019 levels in 2022. What is your assumption on the size of the fleet in 2022 versus 2019? And then secondly, your guidance on free cash flow is for greater than 750 million as early as 2022, which essentially has a lot of flexibility as far as guidance goes. Are you able to provide us with the minimum guide on free cash flow actually in 2022 on the current perimeter? And thirdly, Warren, you provided some comments on your near-term margin expectations for your power systems business. And given EBITA in civil aero is somewhat tied to shop visit activity and engine deliveries, 2 things that you have guided on and which are perhaps not as volatile as the outlook for engine flying hours in the near term. Please can you provide us with your margin expectations in the civil aero business in 2021 and 2022? And then finally, you've injected some assets into ITP to make it perhaps more attractive to a potential buyer. Are you able to please quantify what the sales and EBITA have been injected into that business, please? Thanks a lot.
Yeah. Right, there's quite a lot there, and I have to say I didn't hear all of it completely accurately, but let's have a go at some of them. So size of the fleet in 2022. Look, we're guiding, or we're not guiding, we're making assumptions about the engine flying hours that we expect in 2022, and that's a reflection of activity. It's a reflection of airline schedules and their current plans combined with top-down forecasts. Now, in those current plans, we're not taking particular, it's about airline schedules and their expectations. Exactly how many aeroplanes they're going to have servicing those routes is not something that is of particular relevance to us. And so, yes, we're taking retirements into account, things like, A340s retiring and, 4-engined aircraft generally retiring more than the ones that are current.
We have the last questions coming from the line of Harry Breach. Please ask your question.
Yes, thank you very much. Can you hear me, Warren and Stephen? Okay, can you hear me?
Please bear with us 1 moment, please.
So we're not giving... Sorry, I'm just getting told here the line's dry. Shall I carry on? I'll carry on with my answer. We're not giving minimum 2022 free cash flow guidance, but to help you, what I would say, all things being equal, engine flying hours is the key thing to watch out for here. So 1% equals around £30 million, and the £750 million, we've said 8%. So variation around that 80% number of 2019 levels. 1% equals £30 million. That's probably as best as I can give you in terms of a minimum number for 2022. On your other questions, we're not guiding on civil profit. We haven't done previously, and nor do we intend to. It's a level of detail that we're not going to go into. I think even now is less likely more than ever, given the general uncertainty generally, as we're still in the thick of COVID, and we have all the recovery ahead of us to go through and the restructuring program to go through as well. So I think that's probably going to be something to save up for this time next year. Thanks.
Thank you.
I think there may have been a small interruption on the line there. If anybody did miss part of Stephen's answer and wants to come back to Investor Relations later, we can run through that again. Apologies for that. I think some of you may have lost sound for a short period. Back to you, operator. Sorry, I think, is there any more questions online? If not, I've got just one on the webcast. Two on the webcast I'm going to turn to. Firstly, Nick Cunningham here from Agency Partners, wanting to know more about the longer-term pattern for the major overhauls and wanting to know the impact that has as those visits start to ramp up in the later years. So if you've got any further commentary on the cash flow skyline of the overhaul scenarios, that would be welcomed by Nick.
Yeah, I mean, hi Nick. The shop visit volumes will start to increase. I mean, you'll have seen that from the big, orders that came through over the last 3, 4, 5 years. Those first shop visits start to flow through, and that is built into our plans. They will grow, but so at the same time do engine flying hours. At the same time, we see the non-appearance of the FX costs that I talked about earlier, and we also will have seen the back of the Trent 1000 cost by then as well. So, despite that growing shop visit volume and therefore the cost headwind that goes with it, there are some very significant tailwinds as well ahead for us. So that's how we compensate that.
Just like to squeeze one last question in, and apologies for anybody who didn't get their question answered. Obviously, we will come back to you individually if you weren't able to get a response online. But a question here about SMRs for Warren. Just saying, we're confident in sort of a 2030 target for SMRs, given the pressures on R&D spend and how we're making those priorities. So if you have any comments you'd like to make on the SMR outlook, that'd be appreciated.
Yeah, and so the answer is we're confident in the program at the moment. I mean, this is very early stages at the moment. We've just had the government go ahead, and we'll be fleshing out the detail on that, I think, over the next 18 months to 2 years. But suffice to say, we think it's a very exciting program. Rolls-Royce has absolutely unique expertise in this area, and we see it as an essential piece of net zero for the UK, but also excitingly, as I pointed out in the presentation, for other applications like SAF and hydrogen. So we'll flesh that out over the next couple of years.
Thank you. I'm afraid that's all we've got time for on the webcast questions. We have run out of time. Just to say, for anyone who missed that period of answers, we will make sure there is content in there in the transcript, which will be out later today, or if not, maybe tomorrow on our website. So sorry if anyone missed that. The answer will be published.
Great. Well, thank you very much, everybody. The messages that we need you to take away are that the worst is behind us as far as COVID is concerned. I'm very pleased with the progress we're making on the fundamental restructuring, particularly of our civil business, to reset the economics of our civil business and give us great operational leverage as the recovery happens. and that's going to mean that we can tilt the balance of our capital allocation going forward, so we're well positioned for this future recovery and a net zero world in the future. Thanks very much.